1. Now,
Three, two, one, you're live.
good morning. This is Robert Marson for Wall Street Beats. It's July 16th, a terrible Thursday in the stock market, especially if you own semiconductor stocks. So, I have a few things to talk about today. Some news on the stocks I mentioned here, I was long, as well as an opinion on the semiconductor space. The first day of the month, I wrote a tweet and I said that I've seen a lot of crazy shit in my day, having done this since 1982, and I've seen a lot of stocks get stupid expensive. And you never know when that psychology changes, and you never know what's going to drive that change, what kind of fundamental news. But the semiconductor industry got stupidly priced at the end of last quarter when I believe there was major quarter end window dressing buying of the semiconductor stocks and the memory stocks, which also include hard drive companies like Western Digital and Seagate. The other data center infrastructure stocks, the infrastructure plays, they're very expensive as well, but they were nowhere near the semiconductor space. So I like to buy stocks at one or less times revenues. I'll pay up to two for a high quality, high growth company. I started selling a couple of my semiconductor stocks when they hit 8 times sales, and a couple of them ran to 25 times sales and 15 times sales respectively. Now, if you know how to value a business, and I offered you to sell, I own a McDonald's down the street, and it does $1 million sales and $100,000 in profit. Would you spend $25 million for that? You'd have to be a stone cold moron to do that, or you'd have to have no clue about what you're doing. You just could be ignorant as well. Well, I believe that's what happened with the semiconductor stocks, because the semiconductor valuations on the last day of second quarter of this year were higher than any sector I've ever seen since I've been doing this for 44 years. And the tweet says it's when, not if, this sector blows up, because people do not know what paying 15 or 20 or 25 times sales means. It means you can never make enough money to justify that price. And it might take a year, it might take 5 years, but that price is going to cease to exist unless, of course, the company generates growth high enough to grow into that stock price valuation and stock price you have today. And there are examples, especially in semiconductors in this cycle, where companies have done that. Micron and Nvidia are two examples where the stocks were 10 baggers or more, and the earnings were 10 baggers or more. And therefore, the company's valuation was more than justified, when in hindsight it looked crazy high on 3 years out numbers. Now, I believe I own one of those semiconductor stocks, and I've talked about it, and I haven't sold much of it yet. And that stock is called Silicon Motion. Silicon Motion is about 10 times sales today, which is something I would never buy and rarely, if ever, hold. However, I believe, to make the math simple, that the company is going to grow 100% a year for 2 years. I know that sounds crazy, but that's a good case outcome for the company. And if they do that, 10 times sales trailing becomes 5 times sales on this year and 2.5 times sales on next year. And 2.5 times sales is extremely cheap. So I'm making a calculated gamble that my company will grow into a extremely high valuation. The only other semiconductor stock I own is a company called Intest, and it's a capital equipment company, and you don't have to worry about valuation there. I have a double in the stock since I bought it. Well, I had almost a triple, but I didn't sell it because the valuation was still too reasonable when the stock was 20. It's 14 today. The company is trading for 1.2 times sales for next year, about 1.4, 1.5 times sales for this year. and that's just a 90 stock valuation. There's nothing wrong with a company that's growing 15% a year and does 45% gross margins, and we'll be making I think $1 next year. So it's 14 times earnings. The other peers that they have are trading for 4 and 5 times sales right now. So I don't see how those companies become reasonably valued with their earnings unless their growth is a lot higher than 15 or 20%, which again, I don't know them well enough to know that the companies will have, you know, growth high enough to justify that. So I still keeping 2 semiconductor stocks, but we're in the middle of a semiconductor meltdown. I hope we're closer to the bottom in the current quarter numbers, justify the new stock prices after they've corrected, but we'll have to see about that. Secondly, there's big news on another company in my long portfolio called Electrovaya. The stock had a huge run on obscene volume yesterday. I don't know if I'd buy it after that, but it's starting to come down today. It's around $10, $11. They make batteries, lithium ion batteries, and those batteries have special features. They have triple the normal life cycle battery, and they don't catch on fire, which for a lithium ion battery is a good thing, especially if you're putting it in a data center or in a warehouse, in a distribution center, in a submarine, places, on a ship, on an airplane, and it's a product that you know, performs so well with their specific chemistry and their separator, which is a ceramic separator between the parts of the battery. They they have ex- extremely attractive technology for high end uses, and they announced a deal with Amazon. And Amazon got a bunch of warrants for a decent chunk of the business, a decent chunk of the company, and that vest after Amazon does almost $300 million in revenue. Now, Amazon is their biggest customer, and they'll do around $100 million in sales in the year that starts in October 1st, around 83 this year. So, of that 100 million, I suspect Amazon will do around 40 million of it, maybe. So it's about 40% of the company. But the commitment for Amazon is to dramatically increase their material handling battery purchases because Amazon is the biggest operator of a fleet of forklifts, probably in the world, as they have more distribution center square footage than any company, I would assume. And I would assume along with that goes these massive fleet of forklifts. So the first order they'll get is from replacement batteries as the batteries wear out in their distribution centers to Electrovaya's batteries. The other more important thing is that it validates the IP. It validates the technology. This is a tiny Canadian company, as I said, doing $100 million in sales in the next 4 quarters. That's really a small battery company. And then Amazon would trust them to become a major vendor to Amazon and invest in the company's equity. That's a pretty big deal. And I think that'll bring other customers along and prospects, especially if they're on the fence. And then finally, part of the agreement was to explore uses for this same technology in other applications. So, what does Amazon have that might be another application? Well, they have robots that run around their floors that are not forklifts. They have drones. They're working on drone delivery. They also have an air fleet. They have aircraft to move stuff around, and therefore they have ground service equipment at airports. And Electrovaya already has an order. I think it's from Delta for ground service equipment batteries. You don't want flammable gasoline around jets most of the time on tarmacs. So I would think that Amazon could do something there. And finally, the best opportunity is for data centers. And as I said, when you have a data center, whether the the battery storage is outside the data center, I don't think it's ever gotten inside the data center. It's too risky. But this company and Amazon are co-developing a battery system that would store and condition and regulate the electrons between. It would sit between the GPU racks and the power source. It might be outside the building in massive containers. That's one application, but it also could be in a series of racks inside the data center as well. The company is pushing the inside the data center idea to Amazon and other prospects. And I think a single data center would be about a $40 million battery, and that's not a bad size order for a company that's doing $100 million in revenue. So if everything comes together in 3 or 4 years, this company's business could be more than double, maybe triple, if they execute well, and if this new lead influential customer, Amazon, takes a couple of batteries for their data centers and more batteries for their extensive fleet of forklifts. So, despite the stock trading up and down, volatile in front of this number and our announcement, and after this announcement, I still think it's a good long-term hold at current valuations. If you believe this company could have a period of hypergrowth like Bloom Energy has had, or other companies that service the power side of the data center. So that was a big deal for Electrovaya. And finally, another company of mine that I've shared on this site, PayPal, received a hostile $60 bid. And I talked about the stock in the low 40s, bought the stock around 42, bought more yesterday at 55 because I think at 55 it's an 11 PE and it's 6 times EBITDA, or under 6, because the $60.50 bid that they received in a hostile manner, I think grossly undervalues the potential for the company. So there are other companies that want to build their payment processing capabilities. There's some banks, some other financial companies that want to get bigger in that business, like X, or Twitter. You never know what Elon, could do. He was part of that founding of that PayPal in the first place, I believe, and just seems to me as if a fairer price. You remember, the stock's range for the last 5 years is a high of 300 and a low of 40 and change. And bid 60 when the range is 300 to 40 doesn't look like much of a bid. I even think a couple of years ago the high was 70 to 80. So $60 is an attempt to steal the company. I I would assume no one doing a hostile bid starts with their best and final bid. So I would assume this bid, at a minimum, to be raised 10% if nobody else shows up and the company objects to the valuation. If they decide to even consider talking to the company, they could just say, bleep you, and it's a stupid ass lowball bid, and we're not even going to talk about it. I've seen companies use that strategy and just ignore the bid, say they're not interested, and see what happens. The other company, the acquired, needs to mount a proxy fight. So that's a long process, especially where we are now. That will take over a year. So I don't know if the company's going to even entertain a $60 bid, but it does put the company in play. And that means every company now has an excuse to put together a bid for PayPal, because the first guys that did it at a low ball level. I'm sure they pissed off the management of PayPal, and now PayPal can consider other bids, higher bids, from better financed entities like JP Morgan, And JP Morgan has done buyouts in the past of distressed franchises and fixed them and made them work. PayPal, while not distressed, has not been doing great and has a lot of issues with their technology platform and a lot of issues with high cost. JP Morgan has $40 billion of excess capital and a record valuation and price on its stock. So, and JP Morgan also has a stated intent to increase their payment processing capabilities. I'm not saying I have any insight here. I do not have any, wink or nods from anybody, from Jamie Dimon or his buddies, that they're going to do something with PayPal, but it would be highly likely that if it's true that they do want to increase their payment processing capability, that this would be one big, fast, easy way to do it. If they use stock, it would be very accretive to earnings, especially after the cost cuts and consolidations would happen, and it would increase their payment processing capabilities tremendously. So I believe that that would be a marriage made in heaven, and the final price could be $70, $75 a share. So that's why I bought more stock at 55. There's a very prominent investor, Michael Burry, who owns this stock, and he tweeted yesterday that he thought it's worth 80 to 100. So he's he doesn't have any influence over the stock because even any big shareholder in PayPal can't control the outcome of this transaction if there is one. But I'd be happy with $75, and anything after that is gravy. So the stock is only 55 today. So yeah, as a stock, it's 11 PE stock and under 6 times EBITDA. But I don't think you can go wrong as a stock. And if the stock doesn't ever do anything, the bidders, are probably still there and could return if something happens with this deal. So I believe you have a floor on the stock now because of the bid, and I really believe that the if this bid gets accomplished at this price, that's a travesty, and I can't imagine this deal getting done at $60.50. So there's something been started. We'll see how it finished. I believe that he could still make money from these prices if and when PayPal gets acquired by somebody. So I covered the semiconductor business and the two companies that I own there through this rocky correction phase, Electrovaya and PayPal. It's been a volatile time in the stock market, especially in the industries of data center build out infrastructure, semiconductors, and I would hope we're close to the end of the first downturn. And then we have to see what the earnings do and whether the earnings support the stock prices that exist today. I'm going to sign off. It's now 10:27. And have a great day. Have a profitable trading day. And we will see you next week.